This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to our daily roundup. We have a packed episode today covering everything from major corporate shifts to global economic trends. Let's get right into the headlines you need to know.
OnlyFans faces a new era under its billionaire heir.
Bank of America settles a major sex trafficking lawsuit.
UK television implements a sugar-free Easter advertising ban.
Reform UK's advisor proposes doubling domestic wheat prices.
Foreign investors pull record funds from Indian equity markets.
Geopolitical tensions drive volatility in the Indian stock market.
U.S. Treasury disputes a report on Federal Reserve oversight.
The oldest U.S. Olympian balances curling with law practice.
UK regulators crack down on rising veterinary prescription fees.
Electric vehicles could bolster Britain's strategic fuel reserves.
Starting with OnlyFans. The future of OnlyFans is now in the hands of Yekaterina Chudnovsky, following the death of her husband, Leonid Radvinsky. Chudnovsky, a lawyer and philanthropist, now holds a controlling interest in the platform through a family trust. This is a massive shift for a company valued at over $5 billion. While she is historically focused on cancer research and family life, she must now navigate the complexities of a site that generates billions by taking a cut from explicit content. Critics are watching closely to see if her personal values will alter the site's controversial business model.
It is a fascinating transition because OnlyFans has consistently tried to rebrand itself as a general social media platform rather than an adult site. They even launched a safe-for-work app called OFTV to highlight fitness and cooking. However, the core revenue still comes from adult creators. The company only employs 42 people but managed to generate over $7 billion in 2024. Chudnovsky's leadership will determine if they continue to lean into adult content or if they will attempt another pivot to appease mainstream banks and distance themselves from the pimp labels used by critics.
Next, the Epstein settlement. Bank of America has agreed to a $72.5 million settlement to resolve claims that it facilitated Jeffrey Epstein's sex trafficking operation. This proposed class action lawsuit represents at least 60 women who were victimized between 2008 and 2019, while the bank continues to deny any wrongdoing, stating they did not facilitate crimes. The settlement aims to provide closure for the plaintiffs. This follows similar massive payouts from JP Morgan and Deutsche Bank. A federal judge in Manhattan still needs to give the final sign-off on the deal, with a hearing scheduled for early April to review the terms.
The legal pressure on financial institutions regarding their ties to Epstein has been relentless. This specific settlement covers a broad range of victims connected to any Epstein-associated venture. It is interesting to note that while some parallel lawsuits against other banks were tossed out, the case against Bank of America had enough merit to move forward into this settlement phase. For the victims, these payouts represent a form of accountability from the financial systems that allowed Epstein to operate for so long. The bank statement emphasizes putting the matter behind them, but the reputational damage remains a significant factor.
Now to UK advertising. This year marks the first sugar-free Easter on British television due to new regulations banning junk food ads before 9 p.m. Products high in fat, sugar, and salt, like the iconic Cadbury Creme Egg, are now restricted from daytime viewing. This is part of a broader government effort to combat rising childhood obesity. The impact is already visible in the numbers, with confectionery ad spending nearly halving between October and February. While health campaigners welcome the move, they argue that loopholes still exist. For instance, brands can still run brand-only ads as long as they don't show specific unhealthy products during restricted hours.
Broadcasters and industry bodies are less than thrilled, calling the ban more of a political PR move than an effective health policy. They point to research suggesting the ban only saves about 1.7 calories a day per child, which is less than a single Smartie. Despite this, the advertising landscape is shifting. Companies like Lindt are adapting by featuring their master chocolatier in ads without showing the actual chocolate. It is a major blow to TV revenue, which has seen a 15% year-on-year decline in ad spend from these food categories. The debate continues over whether this truly helps children.
Moving to farming policy. Clive Bailey, the new farming advisor for Reform UK, has sparked controversy by suggesting that trade policy should be used to double the price of wheat. He argues this would fix British agriculture by ensuring farmers are paid more. However, critics are quick to point out that this could lead to a massive hike in food costs, specifically bread, during an ongoing cost of living crisis. Bailey, an arable farmer himself, has been a vocal critic of the current government's inheritance tax changes for farmland. His influence on Reform UK's upcoming manifesto suggests a radical shift in how the party plans to court the rural vote.
The timing of this proposal is particularly sensitive given the global situation. With the war in Iran driving up fertilizer costs and general inflation already squeezing household budgets, doubling wheat prices is a bold and risky stance. Campaigners argue that Nigel Farage's agricultural platform could be a disaster for both the countryside and consumers. Reform UK is clearly trying to capitalize on the frustration of farmers, a third of whom failed to make a profit last year. By positioning themselves as the champions of domestic production, they are making a play for a demographic that feels abandoned by the Labour Party's recent tax hikes.
On to Indian market outflows. Foreign portfolio investors have pulled a record 1.14 lakh crore rupees, or about $12 billion, out of Indian stocks this March. This represents the worst monthly exodus on record, surpassing the previous high from October 2024. Several factors are driving this massive sell-off, including escalating tensions in West Asia and a weakening rupee. Investors are also worried about how high crude oil prices will impact India's overall economic growth. This sharp reversal comes after a strong February, showing just how quickly global sentiment can shift. With one trading session left in the month, the total outflow could climb even higher.
Market analysts suggest that this isn't just about India. There is a broader risk-off trend across emerging markets like Taiwan and South Korea. Elevated U.S. bond yields and tightening global liquidity have made developed market fixed income more attractive to investors. Additionally, while Indian market valuations have corrected slightly, they remain high compared to peers, prompting some selective profit-taking. The concern over declining remittances from the Gulf region due to the conflict is also weighing on the rupee. It is a perfect storm of macroeconomic headwinds that has left the domestic equity market struggling to find a stable floor amidst the geopolitical uncertainty.
Next, Indian market triggers. The Indian stock market just closed its fifth straight week of losses, with the Sensex and Nifty 50 both dropping over 2% on Friday alone. Investors are on edge as they watch 5 key triggers this week, most notably the potential for U.S.-Iran ceasefire talks. Donald Trump has set an April 6th deadline for Tehran to reopen the Strait of Hormuz, threatening the destruction of power infrastructure if they refuse. Iran has already rejected a 15-point proposal that offered sanctions relief in exchange for dismantling nuclear facilities. This strategic waterway is vital, handling a fifth of the world's oil and liquefied natural gas flows.
Oil prices are continuing to climb as hopes for a near-term ceasefire fade, with Brent crude settling above $112 per barrel. For the Indian market, these elevated energy costs are a major drag on corporate earnings and investor sentiment. Analysts warn that the broader market structure remains weak, and any intermittent recoveries are failing to hold. Beyond the geopolitical drama, the movement of the rupee and the persistence of foreign investor outflows will be the primary drivers of volatility. Traders are essentially in a wait-and-see mode, hoping for any sign of de-escalation that could trigger a much-needed rebound in the indices.
Now, the Treasury dispute. The U.S. Treasury Department is in a heated dispute with the Financial Times over a report regarding Secretary Scott Bessent's views on the Federal Reserve. Treasury officials have formally demanded a retraction, accusing the newspaper of publishing false claims about Bessent wanting to increase oversight of the Fed. The FT reported that Bessent discussed a model similar to the Bank of England, which involves regular communication between the governor and the government over inflation targets. Treasury officials flatly denied that Bessent ever endorsed or even discussed such a move, calling the report literally manufactured. They have even escalated the complaint to the FT's parent company, Nikkei.
Despite the pressure, the Financial Times is standing by its reporting. They stated they are confident in the story's accuracy and have included the Treasury's denials in the updated article. This clash highlights the extreme sensitivity surrounding the independence of the Federal Reserve. Any suggestion that the administration might seek tighter control over the central bank can send shockwaves through global financial markets. While the Treasury hasn't made a legal threat yet, they are citing UK press standards to bolster their case. It is a rare public showdown between a major financial news outlet and the highest levels of the U.S. economic leadership over policy intentions.
Shifting to Olympic curling. Rich Ruhonen made history at the 2026 Winter Olympics as the oldest U.S. Olympian ever to compete at age 54. But what is truly remarkable is that he maintained his full-time job as a personal injury lawyer throughout his training and the Games. Unlike many international athletes who receive government salaries to train, U.S. athletes often have to balance their sport with a career. Ruohonen describes a grueling schedule, waking up at 5 a.m. to train before heading to his law firm for a full day's work. Even while on the road for competitions, he was putting in over 40 hours a week for his legal practice.
His story sheds light on the financial reality for many American Olympians. While they receive a small stipend, it is rarely enough to cover living expenses, let alone the costs of elite competition. Ruhonen has been curling competitively for 25 years, but 2026 was his first time on the Olympic stage as an alternate. He spent his weekends throwing rocks for hours and catching up on legal work late into the night. It is a testament to his dedication that he could compete at the highest level while managing a demanding professional life. He proves that age and a day job aren't necessarily barriers to achieving Olympic dreams.
Next, veterinary fee crackdowns. The UK's competition watchdog is stepping in to help pet owners by capping written prescription fees at £21. This move comes after widespread complaints about skyrocketing veterinary bills and a lack of price transparency. The Competition and Markets Authority will also require practices to publish their price lists and introduce a cost comparison website. Many pet owners have reported feeling exploited, with some being quoted double the price for treatments after their local independent vet was bought out by a larger corporation. One owner mentioned being quoted £1,400 for a cat's dental work that costs less than half that at an independent clinic.
There is a real fear that these rising costs will lead to animals being abandoned or left untreated. While many owners still trust their individual vets, the corporate takeover of the industry seems to be driving a wedge between providers and pet parents. The new regulations aim to foster competition and give owners more choices, especially when it comes to buying medication online where it is often cheaper. Some owners described feeling anxious and guilty into paying high fees because they didn't have a benchmark for what was fair. These measures, set to take effect later this year, are a welcome relief for millions of households across the country.
Finally, EVs and fuel. As the war in Iran pushes petrol and diesel prices to record highs, experts suggest that electric vehicles could be a key part of Britain's energy security. Analysis shows that if the UK had the same EV adoption rate as Norway, it could extend its petrol reserves by an extra 7 days. Currently, Britain only has about 3 weeks of fuel in reserve. Every electric car on the road reduces the immediate demand for imported oil. Beyond just saving fuel, these vehicles can act as batteries on wheels. When plugged in and idle, which they are 95% of the time, they could potentially store and share energy back to the grid.
Norway is the world leader here, with nearly 32% of its cars being fully electric, compared to just over 5% in Britain. This is despite Norway's freezing winters and long distances, which are often cited as barriers to EV adoption. The difference lies in a dense, state-backed charging network that has eliminated range anxiety. Experts argue that those pushing for more North Sea drilling should also be advocating for faster electrification. By turning the national fleet into a giant energy buffer, the UK could better protect itself from future energy shocks and the volatility of global oil markets, especially during times of international conflict.
That's our roundup for today. Thank you for joining us for this briefing.
Be sure to follow us for your next daily update on the stories that matter. Have a great day.